So repatriating money from China. I'll start with a story to emphasize how important this topic is. The story comes from a company who was selling antiques to China from Europe. They were selling antiques to many of the main auction houses around China, especially in Beijing and Shanghai. The auction houses could only pay them in renminbi in a Chinese bank account. So they went and opened a Chinese bank account. They accumulated several €100,000 worth of sales within China. But they found that it was effectively marooned in China. They couldn't get the money out. And this was made particularly more difficult as it was the start of this year. And at the start of this year, some restrictions were placed back in to limit the amount of money that companies and individuals could move out of China. We'll touch upon the reasons behind that in a moment. But it meant that their money was stranded and they didn't have an effective strategy to move the money out of the country. This just goes to show how important it is to, before you enter into deals in China, before you start accumulating profit in China, to make sure you're aware of all of the different routes to get money out, because you really don't want to be in the situation where your money is trapped. But it's the reality that money does often get trapped in China, and it's important to know the reason why, or some of the reasons why. And it comes from the fact that China has a restricted capital account. China places restrictions on monetary flows, in particular monetary flows out of the country. And this is for quite obvious reasons for China to protect a lot of its cash reserves, prevent capital flight, prevent the destabilizing of the Chinese yuan and the destabilizing of its wider economy. So they put restrictions on the flow of funds out. So it's important to understand that context. And they put restrictions in place across a number of areas. So they have personal exchange limits. Each Chinese citizen is only permitted about $50,000 worth of transactions overseas every year. So those are in place. There are company exchange limits, but mainly apply to state-owned enterprises or government departments, where it's particularly sensitive for them to move money out of the country. So if you have a customer in China who's a state-owned enterprise or a government department, you will come across this issue. There's regulation over the repatriation of dividends. So if you have your own company in China, you will soon find out that in order to repatriate the dividends, the profits that you've earned through that company, there are several hoops you have to jump through, especially compared to other more open economies in Europe and North America, where the movement of dividends between countries is quite straightforward. And then there's also oversight over foreign investment by Chinese companies and over transfer pricing as well. We'll touch upon all of these areas throughout this webinar. So that's the context as to why restrictions are in place and a bit of detail about what kind of restrictions are in place. However, money does flow out of China. And despite China having a tight grip on many of these valves, if you like, that allow money to flow out of China, those that are open do get exploited quite a lot because there are only a few options to get money out of China. And money flows out in quite vast amounts. The bank UBS found that in 2015, about $330 billion worth moved out of China through formal and informal channels. So it's important to understand what the formal channels open to you. And we'll also touch upon some of the more informal channels as well to give you context to what extent many Chinese companies may go to in order to get money out of China, and to give you context to any discussions you're having where Chinese customers raise such alternative routes. So on the context of moving money out of China, there's constant kind of push and pull. The regulatory environment is constantly changing. The trend of RMB internationalization and the liberalizing of the current and capital account is a push from the Chinese government to internationalize the currency. However, at the same time, there is a pull, especially from Chinese individuals and Chinese investors, to open up more of these channels to get money out of China to facilitate investment between China and overseas. Sometimes the regulatory environment, despite this wider trend of internationalizing the renminbi, regulation does tighten up. So at the start of this year, as I mentioned, there was a directive from the Chinese government to Chinese banks not to permit so much money to be remitted overseas. This was from around January to March this year. It has loosened up a bit since then, which has made it easier for foreign companies and Chinese companies and individuals to move money out of China. But it will change from time to time. So despite maybe learning about the letter of the law or current policies that are in place, you really need to know what's actually going on on the ground in China in order to know how easy it may be at any given time for you to remit money out of the country. So there are a couple of important distinctions to make before I go into detail about some of the routes available. The first one is around currency against jurisdiction. So the renminbi technically is two currencies now. There is onshore renminbi with the currency code of CNY, and it's the currency that we'll all be familiar with when we go to China and use renminbi there. There's also offshore renminbi, which is given the currency code of CNH, and that's to facilitate the flow of renminbi offshore, particularly in centers such as Hong Kong and increasingly London these days, to facilitate a lot of investment using renminbi across the world. However, these two currencies are still quite distinct and different. There are some presumptions that if you have an offshore renminbi account, then it makes monetary flows with an onshore renminbi account a bit easier. Whilst there are some initiatives in place in free trade zones, cash pooling that may be applicable to some larger corporates, for the most cases, it's still quite restricted how you can move money back and forth, even if you have an offshore renminbi account. So we worked with a London-based company who signed a major deal with a big Chinese client, Wanda, the major property developer, and Wanda paid them in renminbi in London in an offshore renminbi account. And the London-based company thought that that would be advantageous so they could facilitate monetary flows between their onshore accounts in China. But they found that the restrictions were the same and it was no more useful than having an offshore USD account, as they couldn't remit the money any easier as they would through any other account. And in fact, they found it very, very difficult to get the offshore renminbi back into China as well. So it's important to distinguish when you hear about internationalization of the renminbi or offshore renminbi, it's still very much a different currency and doesn't ease this bottleneck to any great extent. Second distinction is around personal against company funds. This leads me to possibly one of my favorite stories of my decade of doing business in China. This is to do with an Australian company who was selling the patents of the devices to a Chinese client. And they were struggling to get paid and struggling to pin down the Chinese client of how they would get paid, who were skirting around the issues and all the formal channels that you would expect, international contracts and what have you. So they arranged a meeting in Beijing to settle this issue. However, the Chinese company in their office, in their conference room, presenting them with a sports bag full of Aussie dollars to the value of hundreds of thousands of Aussie dollars, and expected the Australian company to take it on a plane back home. Obviously, they didn't want to touch it. And in the end, they got paid via the relatives of some directors who happened to be living in Australia at the time and used personal transaction amounts to do that. However, it just goes to show the extent to which some companies will go to. And in this case, it's for the purpose of avoiding tax, to be honest. And it's done because, and we've covered this in a separate webinar on getting paid in China, many companies, Chinese companies, have this distinction between personal and company funds, and they're able to draw upon company funds in order to go through some of these informal routes. So that's important context to getting paid in China. So to take you through some of the formal routes that you should be aware of, we'll start with those of you who have a company in China, or those of you who are thinking about setting up a company in China. You'll likely have something called a wholly foreign-owned enterprise, or a WFOE. And this allows you to repatriate the dividends from that WFOE, from the profits that that WFOE makes every year. There's a two-step process. You'll have to pay corporation tax, which is typically 25% of profits. But there are still some areas which give you preferential rates of around 15% on profits. And then when you repatriate, you need to go through an application process, and withholding tax will be levied on that part. And typically, that would be about 10%. But if your parent company is in a jurisdiction which has a taxation treaty with China, it's more likely to be 5% or something below 10%. So for example, Hong Kong has long had a tax treaty with China with dividends at 5%. More recently, the UK has put something similar in place. So find out whether there's a tax treaty between the country where your parent company is and where your China subsidiary is, and then you'll be able to figure out the rates that will be levied. Some of you may be importing into China, which is an advantageous way to potentially get money out of the country, especially if you're importing between related entities. So when you're paying for goods for imports into China from a Chinese entity, it is fairly straightforward application process. You have to lodge the goods contract with customs, with the State Administration for Foreign Exchange, and then take it to the bank and process the transaction from China to overseas. However, there is one important rule to remember before I move on, and that is you must pay for all goods that are imported into China within 3 months of import. That's a rule that was put in place a couple of years ago by the Chinese Customs Office, and it's quite strictly applied these days. If you're a service-based company, you can remit money for the payment of services from a Chinese entity to an entity overseas through a simple service contract. The advantage of this is, whilst it's subject to service VAT, which is just below 7%, it will be exempt from withholding tax in some categories, such as consulting or market research. However, a word on both of these: if you're planning to have a goods contract or have a service contract, which is related to transfer pricing, and just to clarify, what I mean by transfer pricing is when divisions of a company transact with each other, such as trade or supplies or labor between departments or units of the same company. So this is tightening up slightly in China. The tax authorities have been focused on transfer pricing administration. They have been enforcing quite stringent, strongly locally flavored transfer pricing rules, and they've been imposing quite detailed compliance requirements. There's ever increasing scrutiny on related party transactions. So you need to make sure there's arm's length between the entities that you're using for transfer pricing for the purpose of moving money out of China. And again, we have worked with companies whereby they've had a couple of entities overseas. One they've used for the service, so in one case for the service of examinations in China, one they've used as a parent company for the holding company, and they've used one to pay the entity for the service of examination administration, and the other for the repatriation of profits. And it's a case of getting that right balance between those two routes in order to keep compliant. Another area is around managing China costs, and this is an area where actually you don't have to repatriate your profits in China in the case where you've got a manufacturing base there. So we're talking about manufacturing in China for China, and this is a real trend amongst companies who have been manufacturing or sourcing in China for many, many years, but have now found an opportunity to sell there. You can use your entity in China or an agent in China to help you receive the funds and then cover the costs of the suppliers or manufacturers in China. So it's quite an effective way to keep the transactions clean, to avoid export and re-imports, to offset the tax as well, to keep it tax neutral. So if you've got costs in China, whether it be suppliers, manufacturers, or indeed any other small admin costs if you travel there frequently, see what you can use from your revenues within China to cover some of those costs, to simply take away the headache of repatriating money from China. So I've taken you through a lot of the formal routes and how to navigate them. This is to give you context of the more informal routes because it's likely that you may get it may be suggested to you to use some of these routes by a Chinese client because they are still commonly used, because as you've seen, some of the formal routes, there's quite a lot of bureaucracy and red tape and administration around them. So many companies and some actual FX service providers rely on arbitrage networks whereby you pay into one account and you'll receive money offshore from another account. Personal allowances I've covered, and it's very common to have recommended to you by a Chinese customer that you get paid from a personal account, perhaps several personal accounts, depending on the level or the value of the transaction. If you've been to Hong Kong, you may have come across street vendors, Hong Kong exchangers who are providing more informal exchange rates and services to, especially between renminbi and foreign currencies. We're seeing more virtual currency solutions these days, especially Bitcoin is providing a route to facilitate monetary flows in and out of China. And the most extreme example is casinos. And this is just quite an amusing example to give you context of the extent to which some Chinese companies or individuals will go to get money out of the country, to go to Macau or the gambling centers, deliberately lose their renminbi and win it back in a foreign currency. There are new areas of opportunity available to especially B2C companies in China. These kind of payment platforms, such as Alipay, WeChat Pay, Union Pay, provide an opportunity for those retailers or B2C companies who have a website where they can plug one of these payment platforms into their site, or an offline bricks and mortar store where again they can have these kind of payment options available, so the Chinese consumer can simply pay in renminbi and you can receive the money direct into your company bank account or individual bank account in foreign currency. And pound sterling is one of the approved currencies. Most of the major currencies are covered. And it takes away a lot of the headaches that we've been talking about. So if you're a B2C company, absolutely focus on one of these options and see if you can get something in place. Union Pay, which is the main debit card and credit card company supporting most of the bank cards that Chinese consumers use, is also widely accepted amongst POS machines and ATMs in the UK and in many other countries as well. So that's another route where you can get paid and get money from Chinese consumers directly. So just to recap, what are the 5 steps to take away from this webinar to lead you to successful repatriation of money from China to overseas? Never enter into a deal without a repatriation strategy. It's absolutely key. You don't want to be in that situation where you've got money marooned in China and you can't get it out, and it's there for weeks or months. It can really hit your cash flow and affect your business plans longer term. See how much you can leverage your domestic supply chain. So if you've got costs in China that you can cover from revenue in China, that takes away a headache and provides a very tax efficient and clean solution to operations in China. See how much you can maximize transfer pricing, but stay within those rules. As I said, it is tightening. Chinese authorities have got more focus on administrating it these days. But if you've got goods flowing or services flowing between China and entities overseas, that does open up a route for you. Be aware of those informal routes. So when talking to Chinese customers, if they suggest one of these, understand the reasons behind it, understand why they can't go through one of the formal routes, and then you should be able to reach a conclusion with them. And don't put yourself in the position of, like that Australian company, of having to accept a solution such as cash on the table. It goes back to that number 1 point of always entering into a deal with a repatriation strategy in mind, and you'll be able to get your hard-earned profits back to your company overseas. Thank you very much.
Thank you very much, Alex. We do have one question that's just come through from Matthew. So, Alex, are there any pitfalls at the WFOE setup stage which could affect future repatriation?
So it's a good question. So when you set up a WFOE in China, one of the applications after you set up a WFOE is to obviously set up your bank account, but also apply for what's called a foreign exchange permit, basically, which allows you to receive and pay out foreign currency in China. So that's one key application that you need to get in order to remit money, certainly in and out of China. So you need to take that into consideration, and also figure out kind of when you are likely to make a profit in China, and ensure that you have taken into consideration the cost of repatriating that profit, whether it's on a year-by-year basis or every few years.